Quantitative tightening is set to double starting tomorrow with the month of September. Quantitative tightening so far has been running around $47.5 billion a month, and that was the promised amount, and it's actually run a little bit lower than that, but it's supposed to jump to $95 billion a month starting September 1st, and that's going to continue for a while. That would put the balance sheet reduction for the Federal Reserve at about $1 trillion a year. To put this in perspective, we basically added a little over $4 trillion into the Federal Reserve balance sheet over the past 2 years since COVID. So $1 trillion a year is significant, but still only a part of what has happened over the past couple of years with COVID. And when you go back all the way to 2008, when the Federal Reserve balance sheet was $800 billion and then surged to $8.9 trillion at the beginning of this year, you can see that we still have a lot of work to go, even if we do $1 trillion a month. So far, the quantitative tightening has been moving along at a slower pace than promised. It will be interesting to see whether the Fed accelerates to that $95 billion a month level here in September. If they do so, that will tighten financial conditions considerably, and in all likelihood, interest rates will head up and the stock market will head down. It's going to be needed to keep a very close eye on what the Federal Reserve is doing with the balance sheet, as I do think that at some point they will blink, although I doubt they'll blink in the first month or two. Although, given that their staggered slow start, they might already getting weak knees. So keep an eye on the balance sheet very closely. The other item I want to talk about briefly is the discussions with regard to the Federal Reserve rate. So, historically, when inflation has been high, the Federal Reserve rate has gone well above the inflation rate, and that is what has helped bring the inflation under control. Currently, inflation is running at around 9%. We are nowhere near that with regards to the interest rates. So in my opinion, interest rates have to move significantly higher to really have any impact. Right now, at these interest rates, those are still relatively easy money compared to the inflation rate. You can borrow money at that rate, and it's below inflation. That means it's very cheap money. So in all likelihood, those rates do need to move up. The discussion of when we're going to pause over the next 6 months or a year, we're going to pause when inflation is finally back under control and back under at least the 4% neighborhood. And the Fed is still claiming that 2% is the number for inflation as a long-term target. I think that's going to be a difficult task, that they're going to have to reset their objectives on that. I do not think we're going back to the 2% rate environment. So keep cautious here, especially as quantitative tightening is supposed to double, and the pace of the balance sheet, that's going to be a big draw on liquidity. Stay cautious with your portfolio, keep plenty of cash reserves, and wait for better opportunities. The market had already started going down really before they started quantitative tightening. It'll be very interesting to see what happens here over the near future. It does look like this bear market rally ended a couple of weeks ago, and that we are now having another leg down. I would expect it to at least test the lows and possibly break those lows sometime in the fourth quarter. So please keep a very cautious approach. This is Benjamin C. Halliburton. This is buildingbenjamins.com. Please take a look at our website, where we can provide you with a full disclaimer explaining that this is not investment advice. This is merely what I'm doing with my own portfolio. And also, you can take a look and sign up for email, so you can get email alerts as we're taking a look at things, and things come out on a timely basis. You just don't have to wait for it to come out on social media. Please take a look at buildingbenjamins.com. Thank you very much. Good day.